Entrepreneurs face a crucial decision when starting a business. Should they form a single-member LLC or an S corporation? Both offer liability protection and tax benefits, but understanding their key differences is essential for making the right choice. Single-member LLCs and S corporations share several advantages. They both protect personal assets from business creditors, limiting the owner's liability to their financial investment in the company. Additionally, these entities avoid double taxation, allowing profits and losses to pass through to the owner's individual tax return. Let's start by defining each structure. A single-member LLC, or SMLLC, is typically treated as a disregarded entity by the IRS. This means the business itself doesn't pay taxes. Instead, all profits and losses are reported on the owner's personal tax return. On the other hand, an S corporation is not a type of business entity, but a special tax status with the IRS. It also enjoys pass-through taxation, but has more specific requirements and formalities. The key differences between these structures lie in their taxation and management. While both avoid corporate income tax, an S corporation allows the owner to receive a salary and additional profits as dividends. This can potentially reduce self-employment taxes. In contrast, SMLLC owners pay self-employment tax on all business profits. Management structures also differ significantly. Single-member LLCs offer great flexibility, with the owner having full control and fewer required formalities. S corporations, however, must have a board of directors and officers, which can be more restrictive for sole proprietors, but may appeal to businesses seeking external investors. LLCs have several benefits, including easy and inexpensive setup, typically involving just a one-page form and a few $100s. They also have fewer state requirements than corporations. However, LLCs are subject to self-employment tax on all income and must be careful to separate business and personal affairs to maintain liability protection. S corporations offer their own set of advantages, particularly in tax savings when distributing excess profits to owners. They can pay employees a reasonable salary and deduct taxes and payroll expenses. However, S Corp face stricter state requirements, higher formation costs, and limitations on passive income. They're also under increasing IRS scrutiny regarding salary structures. Compliance requirements for S corporations are more rigorous. They must hold annual meetings, issue stock, and maintain detailed records of decisions and minutes. S Corp are also limited to 100 shareholders, all of whom must be U.S. citizens or permanent residents and can only offer one class of stock. To elect S corporation status, an LLC or C corporation must file Form 2553 with the IRS. This can be done at any time after establishing the business entity, but must meet specific timing requirements. S corporations must also file annual tax returns using Form 1120-S. When deciding between a single-member LLC and an S corporation, consider your long-term growth plans, income distribution preferences, and willingness to comply with more formal requirements. If you value simplicity and flexibility, an LLC might be the better choice. If you're planning rapid growth, seeking investors, or want to potentially reduce self-employment taxes, an S corporation could be more suitable. Ultimately, the choice between a single-member LLC and an S corporation depends on your specific business needs and goals. Consider consulting with a legal or tax professional to make the best decision for your unique situation.